when your proven method in the market starts failing and it doesn't give you results? What do you do? Hello and welcome to today's video. One of the challenging aspects of trading is to find out the right strategy that works for you reliably, flawlessly for a very, very long period of time. You may use scanners, momentum indicators, Fibonacci retracement levels, RSI divergence, price action volume, and there are so many things. Regardless of what you choose, the only thing that you can do is just to pray to God and say, "Oh Lord, hope this works. Kaam kara de yaar." This is the only thing that you can do. Trust on your abilities and have faith on the strategy that you have chosen. But you know what? The market doesn't care about your prayers. It doesn't care about your feelings, your hard-earned money. It does what it does. It does what it feels good, even if it's against your well-researched, well-proven strategy. It really doesn't even care. It'll just give you a tight slap on your face, squeeze you beneath your feet, and move on. It'll just move on its way, wiping up all of your capital, leaving you exhausted, devastated, and broken. What do you do? In this video, we'll try and see what you should be doing when your proven method in the market starts failing and it doesn't give you results. So like this video and subscribe this channel right away so this video can reach a lot of people. See, when a time-tested strategy starts failing, it's very tempting for anyone to dump it straight away and find out the next thing that's working, isn't it? This is not a cricket match. It's just because somebody's out of form, you throw him out of the game and bring him back when he is back in form. Just because your trading strategy stops working for a couple of trades or it doesn't perform for a few trades, you just throw it away and you try and bring it back when it starts performing again. This will not only delude you from your own beliefs, but it'll make you fickle-minded. It'll make you impulsive. It'll cultivate a trait, a behavior within you which is spontaneous. It'll make you impulsive and more emotional. If you remember me speaking in my older videos to be more consistent and make the law of average work for you, you're just trying to go against that. So it's necessary for you to stick around with the strategy long enough to see if it has actually grown older and it is not fit for today's world. So if you come across a trading strategy that starts working for you, make the best use of it. Take advantage and capitalize on it. It might so happen that you may hit on a trade or a series of profit-making trades. That's like a string of good luck. See, in the probability theory, there is something known as the law of large numbers. If you coincide this with this probability theory, you know what it says? I'll read it out for you. It states that as a probabilistic process is repeated a large number of times, the relative frequencies of its possible outcome will get closer and closer to its respective probabilities. Now look at this graph. You'll see we hit a probability of turning up a result slowly subsides and settles down after a large number of trials. So you see a series of results on one side of the mean line occurs before it settles down and coincides with the mean average. See, from the first and the second graph, it's very clear that you flip a coin a small number of times, the relative frequency of heads or tails coming up is away from the expected 50% probability, isn't it? See, even if you use a flawed coin, a coin that has got a 65% probability to hit heads, it also converges towards the probability at the similar rate. You see this on the third graph. See, we have used a flawed coin. This test which was performed, they have used a flawed coin that has got a 65% probability to hit heads, and yet it converges towards the probability at the similar rate. So regardless of how long it takes to reach the theoretical probability, sooner or later the two will always meet. Now, why did I bring this up? I did bring this up because when you hit a string of winning trades, be wise to capitalize on it before it eventually settles down. As you see in those graphs, everything settles down to its mean. So when you start hitting a winning trade, capitalize on it. Capitalize on the winning trades before eventually it'll settle down. Now, just as there is a winning streak when a strategy starts working and it keeps on working for a very long period of time, there are other times too when there is a long streak of bad luck. A safe, sound strategy which you always felt is beautiful for you, is going to give you good returns, just stops working. It just doesn't give you the results you wanted. What you can do about it? Very little. There is absolutely nothing. What will you do? The markets are so complex and so many factors that work on the market that it virtually becomes very impossible for you to figure out why your strategy has stopped working, why this strategy doesn't work anymore. And thus, at times there is no workaround, there is no way to work around it. Once again, this happens because of the law of large numbers, which says eventually everything that was working once will eventually come down and settle down to its mean average, which says eventually how good or bad your strategy is, eventually it will settle down. So here lies the confusion. When do you stick, or for how long do you stick to your strategy, and when do you come out? See, there isn't a simple answer. You don't want to abandon it altogether, and at the same time, you do not want to stick to it and eat up your funds. So how do you manage it? There is one thing which you can do is you allocate a specific amount of fund to a strategy. How much of your account will you devote to this particular strategy? So if you have a strategy that's been working for you, which is almost 80-85% successful, you'll be better off to hit batches of 30 to 40 trades at the same time and expose approximately 20-25% of your capital into it. Not more than that. If you win, well and good. But if you lose everything, you lose just 25% of your capital. Not everything at all. But if you lose, you still have 75% of your fund balance, of your account balance, which you can again segregate into smaller amounts, smaller chunks, and try it on different other strategies and try and figure out what works, what doesn't work for you. You've already limited your loss, isn't it? Well, this to me is a good compromise between when you're forced to choose between a stage where either you completely scrap off your strategy or continue using it. I believe this method would definitely allow you to test your strategy to its limit, and at the same time, it doesn't expose more than 20 or 25% of your capital. Unfortunately, there is no foolproof way to decide whether to stick to your strategy or whether to abandon it altogether, because it's you who must decide what you should be doing in the end. It may just be a matter of hunch or an educated guess based on your past experiences. This is what makes trading largely about psychology rather than market perception and technical analysis. So, for those who run after technical analysis classes and courses, let me tell you, it contributes a very, very small percentage in your trading success. A majority of it involves around your psychology, your perception, your belief, and how you take up a trade. What do you do at that spur of the moment? That is all what counts. The ability to hold on to your nerve, to play out the numbers, stay calm, have control on your emotions, and be psychologically well balanced and strong is what all that helps in trading. That's all for today. See you again in the next video. Till then, SC signing off. Goodbye.